Are our pensions at risk? Well, yes, of course. There's always risk in managing pensions, but risk is nuanced. And there is an argument to say that if we all increased our understanding of risk a small amount, we can improve our retirement by a large amount. And that's basically what this module is about. So in this video, I'm going to talk about some simple aspects of risks that most of you will know, but some you may not have heard of. Now, in the world of risk management, which was my profession before I retired, we often talked about upside risk, which in English roughly translates to the chance that things will go better than expected. So we're talking opportunity. Now, risk and opportunity are two sides of the same coin. And if you consider one without the other, you can run into problems. I mean, as human beings, we're programmed to fear losing more than we are motivated to gain things. And this has been proven in lots of social experiments. And it's the reason that if you asked a novice to look after a portfolio of investments, they'd start to lose it quite quickly. Now, our instinct when an investment starts to drop in value is to cash it in before we lose even more. But our instinct when investments go up in value is again to cash it in before they drop. Now, both of these things can be damaging to pension portfolios. Now, as chimpanzees don't really understand investing, if you give the same portfolio to a novice human and a chimp, where the chimp can only make random investments, then the chimp will pretty much always do better. Now, professional investors go through advanced training in risk management and in general are trained to ignore these natural instincts that cause these risk aversion losses. But the problem with getting a professional to manage a portfolio is that unfortunately they insist on being paid for their services. And as they'll only be slightly better than you, then by the time you've paid them, you'd probably been better off with the chimp. So what can we do, as most of us don't generally have ready access to a chimp? Now, the term to remember is index and chill. So let's break that down. An index in investment terms refers to the shares of a large group of companies all bundled together so that if some do well and others perform badly, then on average you won't lose your shirt. Now, the risk is spread. We have started to diversify our investments at this point. So index and chill, spread your risk with an index fund, then chill. In other words, don't keep chopping and changing it. I mean, even better, don't even look at it. One of my subscribers on the course here said that he checks his pension portfolio once a year on New Year's Eve. Now, the rest of the time, he doesn't even worry about it, which I think is good advice. Now, we all know that, for example, Trump's tariffs are causing swings still 6 months later in the markets. And you can think of markets and indices interchangeably for the purpose of what we're discussing here. So if you look at an index week by week over the last few months, you would have seen the index going up and down by 5% or more. Now, take the advice of my subscriber and check it once per year, and that volatility will suddenly decrease significantly. Even better, look at the performance of the indices over the last 20-year period and things smooth out even more. 20 years is my favorite time frame for looking at stocks indices, as this is how I tend to use them. I have a pension pot containing all the money I've paid into my pensions over my lifetime, but I don't look at this as a single pot of money. Much like the last chapter, I'm going to break this down into 3 buckets. Now, I use a different time frame. My buckets are the first 10 years, the second 10 years, and then after 20 years. Now, in the first bucket, the 1 to 10 years, I don't invest this in stock indices because I know these can go up and down. So I invest this bucket of cash in things that are less risky for me. The next bucket, though, is money that I expect to spend between 10 and 20 years' time. Now, this bucket is a mix of very safe investments and some index investments. The final bucket is money I will spend in 20 years' time. Now, I'm 56, so this is money I will spend from the age 76 onwards. And I'm pretty confident that the indices I have invested in will perform well over a 20-year period. So this is a risk that personally I'm happy to take. So let's take a look at some numbers around this third bucket. And to do this, I will look at the average returns of these investments over the previous 20 years. Now, the index I have chosen is a group of over 5,000 companies from all over the world, and I can buy a single investment that splits my money over all these different companies. So if I had invested in the All World Index 20 years ago, I would have, on average, had a return of 8.8% per year. Now, we all know that large world events impact markets, and if we consider four of the biggest events over the past 100 years, namely the Great Depression in the late 1920s, World War II between 39 and 45, the global financial crisis of 2008, then the global pandemic of 2020, then two of these cataclysmic events have happened in the last 20 years, and the world index still returned nearly 9% per year on average. So for money I don't plan to use in the next 20 years, then I like the world index personally. Now, other people have different risk appetite than me, and they chose an index that's more volatile, which is a large American index called the S&P 500. Now, the argument goes that America is different, and this is called American exceptionalism. Now, the theory is largely based on the fact that America holds the world's reserve currency, and this gives it more power, and this leads to better performance for the companies in theory. So let's take a look. So the average annual return of the S&P 500 over the last 20 years has been 10.9%, which is fantastic. Now, whether you believe in American exceptionalism and that they can keep this up for the next 20 years is kind of up to you, really, and whether you think America will continue to perform in the same way. Now, let's consider some other options. How about the FTSE 100, a group of the 100 largest companies listed on the UK stock market? And this includes companies such as Unilever and Shell. Well, these have done less well over the period. The average return over 20 years has been 5.5%. Still not bad, better than most bank accounts. How about we go with something that is much lower risk? Now, if you have a self-invested personal pension or a SIP, then you may choose investments that track the rate at which banks lend money to each other overnight. This is sometimes called a Sterling Overnight Tracker or a SONIA tracker, and I use one of these personally for my buckets. The money I will spend over the next 10 years goes predominantly into this particular index, and this pays a pretty steady 0.1% each week, and this doesn't vary much. That gives a yearly return of about 5%. Now, we can't put our pensions into a bank or keep it under our pillow, but let's consider these options anyway. Let's assume the bank pays us 3% and there's an option to keep your money under the mattress as well for your pension. Now, keep it under your mattress for me, this is the highest risk option, not because of burglars, but because of another pesky risk, and that's the thief called inflation. So the average yearly inflation over the past 20 years has been 2.8%. Now, the returns I've been discussing so far have been nominal returns, and these do not take into account inflation. But inflation's real, and it happens to us all, so we should consider it when we're looking at the returns over longer periods. So if we take off inflation, our new returns look like this. Now let's imagine I invested £100,000 20 years ago. How would we have done? Well, the mattress option, we would have lost £43,400 from the value of our £100,000, or 43% of it. And you can see why this is a risky option. That the bank option will give us £4,000 profits over a 20-year period, and the Sonia overnight tracker is much better, again at £55,300 profit. Now, even though the FTSE hasn't done brilliantly over the last 20 years, it would still return us £71,600. Now, my choice, which is the All World Index, returned $232,000, while the US S&P 500 returned a whopping £322,000.